Well, good, happy Monday morning, everybody. Happy to see you here in our Straddles and Strangles webcast. I'm Connie Hill. Happy that you would join me here today. You know, we're getting into the thick of earnings season. This week, it's going to start coming on pretty heavy, and it's perfect for the strategy that we talk about here, the straddles and the strangles. We're going to go through long strangles today. Initially, we started out with long straddles, then we did short straddles. So today, we're going to do the long strangle. And we've got some interesting candidates coming up that we could use this strategy on. So got quite a bit planned for us here today, as well as following up on some of our trades that we put in already. I am joined in the chat by Brent Moores. Brent, happy that you're here today. We're going to answer your questions. Brent will pick up those things maybe I can't quite get to, but I will keep my eye on the chat. Now, there's so many friendlies here. I've got to just say a quick hello to some of you. We've got John, we've got Janelle, Kelly, Kevin, Snip Stano. I don't know if I said that right. I hope that's right. Life in the Fast Lane, JDMI, Riceberg, Tina Favors, all sorts of folks out here. Appreciate you coming and seeing your faces. Not your faces, I guess your writings here. Let's go through our disclosures and we'll lay out our agenda for today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for education and informational purposes only. Don't consider it a recommendation. With long options, you could lose 100% of your funds invested. We will be using the Paper Money software application. It's what you download to your computer, the most robust version of Thinkorswim. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. That's one thing that's a little bit different on Paper Money than your live account, is that Paper Money does not assign early. So be aware of that so you don't have a false sense of security. When investing involves risk, including the loss of principal, there's no guarantee that an execution of a stop order will be at or near the stop price. Past performance is no guarantee of future results. All right, I want to give you a reminder here of a few things. Number one, we've got some market drive and workshops coming up here. So Anaheim, Houston, Miami, all through the end of the year. If you're close to one of these or can get there easily, I'm going to recommend that you do so. The other thing I want you to be aware of is we have a virtual advanced options workshop starting tonight. It's going to start right at 5 p.m. Eastern time. Okay. So if you're interested in attending, we have a lot of people that have signed up. I want to show you where to go to so that you can register yourself as well if you're interested in coming. Come over to Schwab Coaching, log into your account, look at Learn, come over to Schwab Coaching, and then come on down here. And then it says live webcasts and virtual events or virtual workshops. That's where you go. You can view the calendar there. You can start with today, and you can go ahead and let's get down to the 20th here. Advanced Option Strategies Virtual Workshop. Click on there. You'll be able to get in from there. You can also get in via YouTube if you're somebody that's used to just kind of using the YouTube access on that. All right. So if you're interested, join it. We've got it for you. Now, I mentioned a little bit what our agenda might be. We're going to take a look at a couple. Well, we're going to start out actually with some new trades, okay? And then we'll do a little bit of follow-up work on some of the trades that we've already been done or we put in previously and kind of see how they fared with some of the strategies that we use to manage them, okay? So let's get started. Hop over here to my Thinkorswim. And let's go, we'll start here on the charts. Now, first thing I'm going to share with you is a script. Remember, scripts are not guaranteed as to accuracy or timing, but the script I'm going to share with you is really a helpful little script. It's called the Market Maker Move. And the Market Maker Move essentially tells us or shows us how much implied volatility is being priced into the options. And so as stocks are coming into earnings, what happens? That typically ramps up for stocks that are big movers. If they're not big movers, then it's not such a big deal. But for straddles and strangles, we're looking for the big movers. Sometimes that's going to mean those names that are kind of big news stories because they have a tendency to move big and move the overall market. So This particular script, remember, scripts are not guaranteed as to accuracy or timing. It's going to graph this on the chart for you. So let me put it out here in the chat. All right. Those of you that are listening to this on the recording, I kind of highlighted it here in my charts or my chat or my scratch pad. Okay. So you might have to pause and look at it. When we go to another chart, I'm going to put it in a text box for you. Okay. Market, what's it doing? Well, I guess it's still a little bit more positive today. Things always change, right? Up and down. Right now, we're up on the S&P about 1%, maybe a little bit less than 1%. Okay. Now, John says, I've been in Berlin. Cool. You spent 3 years living in Berlin long before you ladies were probably born. When Reagan said, tear down this wall. Cool. You've got some international exposure there, John. So what we're doing here in this class, long strangles and long straddles, we're going to be buying options here. Let's take a look. Let's open up our first example here that we're going to use. A couple of our example trades here are ones that have earnings this week, and some of them are going to be for the following week. Okay, so this is going to be one for this week, which is Intel. Now, this market maker move, that script that I put in here, shows it that they're expecting a move of about 9%. If you're wondering, is that a big move or not a big move? That's a big move. In fact, that's going to be the largest move that we're going to look at here today, is this 9% move. And then it also gives you a dollar figure. Okay, rough numbers, that means they're looking for the move to be approximately either $3.50 up or down. We don't know what direction it's going to go, right? We all find out all together when they announce their earnings. And then these two yellow lines here on the side show us, okay, if the market maker move goes up $3.50, here's the line. If it goes down $3.50, then there's the line. Okay, so it gives you an idea, expectation of movement. You can see Intel has made some decent moves recently. We can see their last earnings, there was a gap. Earnings before that, I'm going to say it was a smaller gap, closed here and then opened up here the next morning and continued to run. It didn't run after that. That's something to maybe note. Earnings before that, kind of a big mover. I think Intel more than anything recently has started to move. A lot of attention, things going on with the semiconductor space and their involvement in that space and the need to ramp up quickly as possible all of these semiconductor products that we need for AI and so forth. And so they have become more volatile, although in the past they were not quite so much, because you can see in here, these are just small little moves, okay, over in this period of time. And it was really back here in September when they got a huge boost, and then it's continued to run here for a little bit. Okay. All right, let's go to the trade tab. Now they have earnings here. It's going to be the 23rd, which is going to be Wednesday afternoon after the market closes. Is that the 23rd? No, it's Thursday. Thursday is going to be the 23rd. Okay. I've got implied volatility here, and you can see how it's been ramping up on Intel as we've been going along here. What does that mean for option prices? Well, that means option prices become more expensive, right? The implied volatility piece of the option premium, yeah, it starts to inflate. That means the value of the option gets higher and higher, which means it becomes more expensive for us as a trader. And actually using a strangle here is going to be really interesting. So as we come through here, let's go over to see the options that are available for this one. Can you see how much implied volatility extra is priced in here? 129%. And then the next week out, still pretty high at 98%. And then we go down to 87 and 80. So a ton of implied volatility, whoa, is baked into the price of these options. For a different strategy, not one that we cover in this class, but for a different strategy that I've been using in our option strategies class has been a double calendar. And with the double calendar, we look for this big mismatch. We look for a high implied volatility here. But in this case, because we're buying the options, and sometimes it takes a little bit longer for the stock to make the move to get to our strike prices that we might use for, say, like a strangle. Probably using these weeklies is not going to be the best choice. Okay, probably coming out a little bit further where implied volatility isn't as high and giving the stock a little bit of time to move after the earnings can be part of the consideration when you're looking to do this. So on this one, we are going to use, we can actually use here the November 7th. This is going to give us about 18 days. So we're going to be in it this week. Implied volatility may ramp up. It could increase the price here. Now with a strangle, we're going to use out of the money options. A straddle, we go on just either side, whatever the at the money strike price is. Right now, Intel's at about 38 bucks. And so if we were doing a straddle, we'd buy the 38 put and the 38 call. With a strangle, we go out of the money a little bit. What advantage do you think maybe a strangle might have over a straddle? What advantage might a strangle have over a straddle? Just to think about it. Now, some of you might not be exposed to this particular strategy that much. Okay, so that might be new to you. But one, if we go out of the money, are the options going to be lower priced or higher priced? It would be a little bit lower priced. Okay. So that's one consideration. That means there's going to be less risk per contract, okay? And if the stock does make a big move, like we're expecting it to, then it could give us a really nice leverage point. Now, the thing we also have to take into consideration is that if our strike prices are out further, that means the stock's got to move further, okay? But if we're expecting a big move, might be not a big deal. Kelly says maybe one of the other things that might work to the advantage of a strangle over a straddle is having a lower delta. And that could be implied in the price of the option. Sai wants to know, is this a bullish strategy on Intel? We don't know. It could be bullish or bearish. We don't know the direction the stock's going to go, right? We're playing it simply for the move at earnings and knowing that the market's expecting a big move here, okay? So let's go ahead. Let's put together our first trade. Since 38 is our at the money, we're going to go a little bit out of the money. Now, we could go out $1. We could go out $2. And the further you go out, the cheaper the option is, but the stock has to move further. And so if we're expecting a $3.50 move, we probably don't want to go much more than that, right? Because that's what they're expecting the move to make, but we actually need it to go beyond that, right? Or would like it to, I should say. So what we're going to do here, we're just going to go one strike out of the money. We're going to buy the 37 put, which I'm going to go ahead and select on. And then over here, we're going to buy the 39 call. And you can see we've got on both these contracts, decent open interest here. The 50-cent increments don't have as much open interest, but the single strike increments do because they've been out here longer. Okay, so they are going to have some decent activity. But do you like this spread here? 211 by 225 is about 14 cents. So not too bad, okay. 242 by 253, okay. That's going to be what, 9 cents there. So the bid-ask spread on this stock are fairly narrow. Now, if you felt that maybe the stock would not make that big of a move, you wouldn't even use this strategy. One thing we want to keep in mind is whatever we pay for the premium, we need the stock to go to that point and beyond, right? Because we need it to cover that. So we need it to go, if we're choosing a 37 strike, our break even is going to be 37. And then we have to take into consideration this 225 premium and the same thing on the calls. We'd want it to move up to 39 and beyond, right? In the neighborhood of $250 or $2.50 per contract. Okay. So let's kind of see, there's a few questions right here from the get-go. So let's clear up some questions. Now, Paul says, my understanding was that implied volatility falls after earnings. Isn't a further out expiration too long of a time frame? I like that question, Paul. Implied volatility is going to come crushing out. It definitely will. Which contracts will this maybe expose the most? Which contracts we might be using? I'm going to just collapse this a little bit. It's really going to severely, it'll hit all the options, no doubt, okay? But the ones that it's going to hit the most are these that have the highest amount of implied volatility. So if we were doing a selling strategy, okay, then yeah, we might want to pick one of these that really has a lot of implied volatility priced in it because we want to capture that. Now, as we go out further in time, that implied volatility, we go back to the chart, you're absolutely right. What does it typically do after earnings? Yeah, it comes out. That very first day, most of it comes out. Now, it can continue to drop after that. And you can see here the last time they announced earnings, yeah, that was a big drop off. So an option that we have out a little bit further in time, yep, it's going to be impacted by that. We would like implied volatility to go up, ideally in an ideal world, right? But we're going to go a little ways out from where that big implied volatility drop is going to be so that we're hoping to maybe avoid that. Okay, so I appreciate that question. Can we use the probability cone? We could throw the probability cone in here. It's not going to show anything much different than what we're talking about here as far as using the market maker move, but you could use that as a tool, absolutely. So let's see. You don't care. Yeah, we don't really care which way it goes. We really don't. And that's probably good because we don't know. Nobody knows what way it's going to go. We don't know what they're going to say. We don't know if how the market's going to react to what they say. If they increase their numbers for the future, great, but we don't know that they will. But the idea, if we go out a little bit more in time, would help it if maybe it makes like an initial move, but we need it to continue to move a little bit further to be more advantageous for us. So in all likelihood, we would not expect to be out of this trade, at least one side of it. We'd probably expect to be in one side of it when we get together next week. Not guaranteed, because if we get a huge return on it, we might just go ahead and sell it. Now, strategy-wise, we're going to be watching these earnings. We're going to watch and pay attention Thursday night when the earnings announcement comes out because we want to know that initial wave that we think the stock is going to move. If it's bad news and it drops big, it's not guaranteed to open there the next day, but it kind of gives us an idea of what the market thinks about, at least initially, about the news. I have seen stocks gap down, maybe when the announcement is initially released, that information. And then maybe they have a conference call the next day. And then during the conference call, they explain a little bit more of the numbers. And then the reaction goes the opposite direction. Okay. So it can be pretty volatile. In fact, one of the options that we're going to look at, one of the trades we did, it was really interesting because it was really volatile. Okay. Let's see what other questions we have out there. Brent, thank you for helping me out with some of these questions. Yeah, because these can be newer strategies. Yeah. You don't need the market to crash, and we're not expecting it to crash. We're just focused on this one stock. Okay, so let's go ahead. Let's put it in here. And we know our market maker move is for essentially about $3.50. We're going to be paying more than $3.50 here. We're going to be paying $4.61. So in reality, we do need it to make a bigger move. In an ideal world, we would be selling the loser immediately and trying to just salvage what we can out of the premium. And the side that looks like it's winning, then we would hope it has a decent move and that it continues to run. Maybe like a little gap and then a continue to run would be ideal. But again, sometimes we don't get ideal. Okay, so we're going to keep this in mind. Let's see. China says if it says a combo instead of a straddle, is that the same thing on the trade ticket? So here, what I did is I held down my control key. We use the, let's see, the 7th here. And what I did is I clicked on the ask price while at the same time holding down my control key on my keyboard. If you're on a Mac, it's going to be that command key. And then it'll allow you to put both of them up. And then you can see here, it does show that it is a strangle here. Okay, if yours shows a combo, just make sure you're buying +1 on both of these legs, and that one is a call and one is a put, and then we're doing it out of the money. Okay, strike the at the money's 38, so we're going to go 37.39. All right, let's go ahead. We're going to throw this guy in, and again, my expectation is that Friday likely will be out of one side. Probably the losing side, and trying to just salvage out of it whatever we can get, right? Because our expectation is that one's going to be a total loser. Like we might totally lose the premium of one of them and hopefully increase in the premium of the other. Now, is it possible we could lose on both of these? Is that possible? It is possible. It is possible if the stock really just doesn't move that much, we could lose on both sides. Okay. So it's definitely, I would say, a strategy for speculation. It's not a strategy for high probability. Definitely keep it in the arena of speculation. Let's see. Tatiana says, can I just choose a strangle on the trade tab? I think that's another option. Let me just do a right mouse click. And we can say buy. And then we can come in here and choose strangle. And I started at, I think I started at the same strike price there. Maybe I didn't. Now I started at 37. And so it just went and grabbed the next one out in sequence. It doesn't know that we didn't use the 50-cent increments, right? So then if you did it this way, come down here on the call and then just change that to our 39 strike price. Okay. So you can do it either way. Either way is fine. Okay. Can we do a conditional order on this? We can do anything we want with this. We could put on a conditional order that says, if the stock moves down $1, sell this one. If the stock moves down, or I should say the value of the option, if the value of the option drops a certain amount, we want to get out, or if the stock price moves. A lot of times in this particular strategy, it's kind of making a quick decision after you see the reaction. But if you wanted to program yours to say, hey, if it goes down whatever amount that you want to be out, you absolutely could do this. The loss should not be infinite on this. The loss is limited to what we paid. We cannot lose more than our net debit. So whatever we pay for it, that's what we could lose. If we're doing short options, that's when we can lose more than the initial credit that we get in for the trade. So on short options, yes, we can lose more. There is theoretically unlimited risk if you're selling a call, man. And say you sell the call, you caught the premium, but you want the stock to drop so you can kind of keep that premium and it goes way up. There's no telling how high that could go. And that's why that one would be unlimited. Okay. You guys are having some great questions here. I'm glad that you're asking it. All right. I think between Brent and myself, I think we've caught those particular questions. Okay. Now I'm going to show you one that we're not doing. And I'm just going to show it to you real quick here. Okay. A stock that has been a big mover historically, almost like its whole life, or at least it seems like it's been its whole life because it's been doing it for years, is Netflix. Okay. Netflix is a big mover over earnings. You can see on this 1-year chart, you can see the big gap here on that earnings. This earnings, a little bit of a move. That was a big move, not necessarily a huge gaping move. This earnings here, there was a little bit of a gap down, and then it did continue to fall. But this is an expensive stock. It's a $1,200 stock, and these options are really incredibly expensive. Okay, so that is the reason we're not doing this one. Okay, we're not doing Netflix because of that, even though it has a market maker move of $82. So it is expecting a really big move, which is 6.7%, which I'm going to say is in the big move category. But because it's probably not maybe that realistic for a lot of people in our class, that's the reason I'm just going to skip over it. Okay, but if you wanted to paper trade it, that could be another one that is a big mover. Let's take a look at one more stock here. Am I using a scan to find the trades? I'm not, Wiley. I'm not using a scan, although you could probably create a scan to find earnings in the next 5 days or earnings in the next 2 weeks or whatever time frame you wanted to do. I simply was using the calendar. Okay, I was on the MarketWatch calendar and I looked at the earnings for the week we're in, the 20th, and for the 27th going forward. Okay, so I was really, and all I did is I clicked on it here, and there's several choices, but you can see out here, this one has 42 days or 42 earnings after the market closes, or actually before the market opens, and then after it closes, 96. So Wednesday is going to be a big earnings day. You can see over here, is that 91 before the market opens and 75 after it closes and some in the middle of the day. And so I just highlighted the day and just kind of went down. And when you've been in the market for a while, you get a feel for what are the big movers over earnings. Okay. And that's what we want. If it's a little mover, we're not that interested in it. There were several that I pulled up that I was like, it's an okay move, but maybe not huge. And we really are looking for the big, big movers. Okay. Paul says, do you distinguish between a short and a long by saying buying versus selling a strangle? Yes, you're absolutely right. So when we're selling options, yeah, we're going to say we're short the options, and we're short on the trade. We're thinking short on the stock, and that really just means, yeah, we're selling the options. Long means we're buying. So today we are buyers. Okay, so let me show you our next paper trade we're going to do. It's Philip Morris. Now, I was actually a little surprised that Philip Morris was as high as it is. But then I looked at its history and I was like, well, maybe it's not big in the news of making big gaps, or maybe it's a stock I haven't been paying that much attention to. But look at this big gap here at earnings. Actually, come back here. It had a big gap up here and ran the next day. Here, it closed at 130 and it gapped up to like what was the opening price there? 145 and change. Okay, so big mover that earnings. Right here, we can see a little bit of a gap. Last earnings, we see a big old gap of it dropping. And even though we have the market maker move, and even though we know 6% is priced into the volatility for the event, it's not until Friday. It's for the event of earnings. And so here, these guys are due to announce tomorrow afternoon. So we'll know a little bit sooner on it, what direction it really goes. But you can see this market maker move. You're like, yeah, that is kind of a fair distance, isn't it? Implied volatility has been ramping up here, which is really common going into earnings. Let's see how the pricing of the options work or look here. Okay, let's go to our trade tab. So because they announced tomorrow, this front week is where most of the implied volatility is loaded. So look at this, 75%, and then the next week out is 50. That's 25% volatility higher, which I'm going to say is very large. Okay, very large. Again, maybe people might focus, if they wanted to focus on selling strategies, or say it's short strangle, short straddle, they could come in here to the weeklies, but because we're doing long straddles, I wanted to go out a little further, reduce our exposure to this implied volatility that's just going to come crushing out Tuesday morning, maybe. Well, actually, tomorrow night they announced, so I guess Wednesday morning, Tuesday night comes crushing out. Okay, and then on this particular one, I was looking to do the November options out here. There are some weeklies here, but it's not as liquid as what I'd really ideally like to see. And so that being the case, and knowing we're going to go further out anyway, because we want to allow the stock to make and continue to move after the announcement, we want to have enough time there. Okay, so we're going to use the November options. Let's see where the stock is right this minute, because it's been moving around 157. 72. So what's our at the money strike price? Yeah, our at the money strike price is going to be this 157.50. Now you're going to notice it has 0 open interest and just some activity here today in the volume column. Okay, so that could be, let's see if that's true on all the 50 cents. It looks like it. So they must have just rolled these out today. Today's the first day of trading for the ones in the 50-cent increments that we can see out here. Okay, so if we're going to go out of the money, because the string goes out of the money, in this case, on the put side, well, the next out of the money one is this 155. So $2.50 out of the money. It's going to cost us $5.60. Hopefully we can get in maybe at a midpoint price here. I'm going to do the same thing where I'm just going to click on the ask price, hold down my control key so it cues that up, because I want you to be able to see over here as well. And if 157.50 is our at the money, then 160 is going to be our out of the money. Again, we could go further out of the money. We could go out to 165 and it would be cheaper, but that move that far out might not really be priced in. If the market's expecting a move here of 948 and we're going to have to pay 1135, so we know it's got to make a bigger move than just the market maker move. Well, we're buying enough time so we can afford that, right? We're buying some time so that if it makes a move, it can continue to run. We'll quickly sell the loser, whatever looks like it's the initial loser, right? If the stock pops, we're going to go sell our put. If it drops, we're going to hold on to our put. We're going to go sell our call and just see what we can get out of it. But realistically, in your mind, consider it a loss. Consider that you're going to just lose the whole thing. So you need a really big move on the side that moves to really help make up for the one that you're basically you have to throw away. Okay, that makes sense. Is Philip Morris making something other than cigarettes? You know, I haven't followed their business model to see how they've expanded, or if they have, I honestly do not know. Let's see. AJ says, if you're doing the long straddle, how early should I do it before earnings? 1 week, 2 weeks, or 3 weeks, or does it not matter? It can matter, AJ, and sometimes we'll do it just as we're going into earnings. Sometimes we'll plan in advance. In fact, our class from 2 weeks ago, we planned in advance for stocks that weren't announcing that week. In fact, they're not announcing till this week. We're going to take a look at one of those to see how it's doing because they haven't announced yet. Okay, so we're going to see if implied volatility is ramped up and it's increasing in price or not. And I want to do another example here where we go out 2 weeks if we have time, or actually 1 week to next week's earnings, and look at Apple and PayPal. They don't announce this week, so maybe we would get the implied volatility ramp up. It might help our position. And if it, say, ramped way up, maybe some additional news comes out, and you're looking at, say, both your legs are profitable, and you're like, I kind of like what I'm seeing here. I like this profit just from the implied volatility ramp up. You might choose to say, great, I'll just take the gain that way. Now, it's not that common that it's going to move up that much, but if some news broke or something, yeah, it possibly could ramp up even more than, you know, just a little bit as we get into earnings. Okay. So again, our break-even points are going to be further out, right? We're paying less because we're going out of the money, but then we're going to have to hit, say here, 160 plus the premium is what ideally we need it to move. Now, what's interesting here, I'm going to collapse that for just a moment as we come over here. For the option that we're going to buy, we're expecting before they expire to move $14.33. Okay. The market maker move, what we're seeing up here is just for the earnings event. So once the earnings come out, you know, the implied volatility crushes out, but that's still what the expected move is on the ones that we're going to buy. So about $14. Well, good. We would want it to move at least $14, right? Because our premium that we're paying on this is $11.45. So absolutely, we would love for it to move that far. All right. Beauty says, maybe I missed this, but with strangles, do we generally choose a middle of the road delta? No, we're actually not going to focus on delta that much. We're going to focus on slightly out of the money. Okay. Because you can do it like we did here, 160, 155, or you could go even further. If you go further, it's going to cost less, but we're going to need the stock to move more to get beyond that break even. Okay, so that's why I'm kind of pointing out what's the expectation of movement on these November options. Well, we're expecting it to be $14.33. I shouldn't say we, but the market's, that's what's being priced into those options. All right, I'm going to send this little guy off, and we're going to put it in our straddles and strangles bucket. And very quickly, let's take a look at Apple. And then I want to show you a couple of our trades. This one we're going to move through fairly quickly here. On Apple, you'll see they have a little bit more time before they announce. They're not going to announce until the 30th. Okay, so we've got a good 10 days before they announce. They're usually after the close. So they will be after the market closes out here. And you guys probably know, oh yeah, I hear Apple in the news when they announce earnings. Yeah, they have a tendency to be big moves, right? In fact, this move here gapped clear up here and then dropped. Here we see a little bit of a gap down and continue to drop. The one that was most recent looks like it dropped. Let's see, the date that they announced, it dropped, and it dropped a little bit more, and then later it just recovered, I think, as more information was coming out about, I don't know if it was leaked news about their product. I can't remember what exactly fueled this move, but then it went the opposite direction. Okay, so we have to be very much on top of these and paying attention to what's going on and not just hope it goes a direction. It's kind of like, yeah, we're buying both sides. We don't know which way it's going to move. So we're going to do a strangle here as well. We're going to go after these November 21 options, even though their announcement is going to be the week of Thanksgiving. And you can see it's got maybe 8% additional implied volatility from here. All right. 263 stock, so it is a little on the expensive side. Our at the money would be this 262.50. That's our at the money strike price. So we could choose to go out of the money at 260 or 257. You can see the market maker move isn't even showing up here yet because it's for further out. So that means implied volatility could ramp up. Those premiums could get more expensive. On this one, we are going to go with, let's just go with 260 on the put side. And then we're going to go 265 on the call side. So we're going to want it to move a lot. We're going to want it to move our price that we're going to pay for it, knowing that we're going to lose one side, is $15.68. And so the expected move is out here to $19.50. So by the time that we get to options expiration, that's the expected move. We're not planning to hold in all the way to earn till they expire. Okay, but we are going to stay on top of it. This one will probably still be in the trade next week, unless some big news happens and we're like, ooh, we just want to take the profits on it. Okay. All right, we're going to send this one to our straddles and strangles bucket as well. And we're going to have some time to watch this particular one because it's not going to happen this week. Okay. Zach says, the PMC is showing that it's hard to borrow. I kind of laugh at that sometimes. I shouldn't say laugh. Let's see. Where is it showing hard to borrow? Is that on trying to remember where that shows. I don't think it's in this extra space. Oh, it's up. Well, it's showing extended hours eligible. I'm not seeing the hard to borrow phrase up here. Usually it's up in this area, I think. Okay. I'm not seeing that on mine unless I'm blind. Okay. Philip Morris usually is pretty liquid. Come out here and look at these contracts. When we're talking about hard to borrow, remember that reference to stock. And if somebody wanted to buy the stock, they could, right? But our purpose is trading the options. Okay. So as long as there's liquidity out here in your options, I don't think you need to worry about that too much. Okay. All right. Maybe it's in paper money and not on the life. Oh, it's on the life platform, not paper. Okay. But remember, that's dealing with stocks. We're not going to borrow stocks from the broker. We're just buying the option contracts. Okay. I wanted to spend a little bit of time on trades that we put in. Okay. First one we're going to go to really quickly is TXN. TXN we put in 2 weeks ago, and we bought it way out in front of earnings, okay, because they are not going to announce until tomorrow after the market closes. All right, so we're still in this trade, and implied volatility really has not done that much for us, okay? We're actually down on it. So we're going to hold it over earnings tomorrow. The one I want to spend just a moment on is J&J. J&J, we did on this one. Let's go see our strike prices here real quick. On J&J, am I looking at the wrong stock here? Maybe I am. We're out of it. That's why it's not showing up here. Yeah, we got out of it. Okay. So on J&J, let's go to the trade tab here, or not the trade tab, the account statement here. Kind of go through this math a little bit quickly. So on J&J, we did this last week, and we did a short straddle. That means we sold both legs. Okay. So we sold the call, we sold the put. We brought in a total of $5.64. Okay. Now a short straddle is when we're not expecting a big move. And this stock moved more than what we wanted it to. Okay. Which I'm kind of happy that it did, because I want you to see that short, you're selling stock or options and they're naked and they don't have protection, it can go against you. See how volatile it was on this day? If I had been watching it like a hawk, I wasn't that day, okay? I was aware of it, seeing what it was doing. But theoretically, when the stock went clear down here, our short call could have been in great shape to go buy back up. When the price of the stock rallied up here, we might have been a little bit more favorable for us to sell our put. But when I was looking at it, it was just sticking like $1 and $2 next to our strike prices. So really, we left it in place until Friday. And on Friday, we finally had to, I wasn't sure where it was going to be, if we were going to be assigned a call or assigned a put. We went ahead and closed both legs. But we didn't make money on it. Even though we brought in $5.64, to buy it back cost more. Let's see, on J&J, we had to pay 9 cents to buy the one back. Actually, I take that back. This one we did make money on. We brought in $5.64 and we bought it back for $3.25 plus 9 cents on this side, so $3.34. And so on this one, we ended up making about $2.40 per contract, or $240. Okay, but we did have to stay on top of it. All right, my time is up. I hate it when my time gets up so quickly, but that is the case today. The other one we did was Morgan Stanley, and that's the one we lost money on. Okay, we lost on both the call and the put because that was the one that made a pretty decent move on us. So on Morgan Stanley, we brought in $7.20 total between the two legs, but look how much we had to pay to buy back this call. The 155 call, we had to pay $10.80. So even with it alone, that's the side that went against us. Okay, we closed it out quickly. The put, we left on a little bit longer, like an hour or so, just to kind of get more implied volatility out of it, but then just eventually bought it back for real cheap, because you never know when it's just going to move on you again. Okay, so that's how those two trades fared. All right, Brent, thank you for your help out in the chat. Appreciate it. We had a lot of questions here, which is good. I love seeing so many questions as you're trying to understand these strategies. If you want to paper trade it with me, it's a great way to learn. Just do the same example trade in your paper money account. Then you'll have questions. We'll address what those questions are. But if you're not following along with it, you don't really know what the questions are, right? Because you're like, I don't know. I was just sitting back here eating bonbons and Diet Coke and watching you trade it, Connie. Okay, you'll learn a lot more if you do the example trades in your paper account. All right, we're going to follow up. We've got like 5 trades to follow up on next week. Okay, guys, appreciate your being here Don't forget to subscribe. I think most of you are subscribers, but if you're new and you haven't subscribed, if this was helpful today, hit the like button on the way out. And follow Brent and I on X. Brent Morse CS, Connie Hill CS. All right. We have a class coming up next at the top of the hour. So go refresh your beverage. And we are going to have trading a smaller account with Barb Armstrong. She's going to be up next. All right. We'll see you next week. Actually, I'll see you sooner this week. I'll see you tomorrow. But for this class, I'll see you back here next Monday. Bye-bye.